So, hello everybody, my name is Radovan Vojtko and I'm CEO and Head of Research at Quantpedia, and I'm very happy because I have a guest here and I have a Cengiz Eller from ProsperityAlgoSolutions. We will have a discussion today about algo trading, algorithmic trading, quant bots, etc., etc. But I will leave Cengiz to introduce himself. So, Cengiz, tell us something.
Yeah, thank you very much, Rado. It's really fun to be here today. I'm looking forward to our conversation. So I'm Cengiz Eller, founder and CEO of ProsperityAlgoSolutions. Prosperity Algo, we're a developer of algorithmic trading solutions and bots for primarily high net worth retail clients. So as I'm sure many of your viewers know, there's a lot of folks in the bot development space, and we really aim to differentiate is to make like stable investment grade algo solutions more so for traders and investors who are not trying to flip an account 17 times, but more so have consistent portfolios for long-term performance.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
Thank you for introduction. So we will have a discussion about algo trading. And as a Prosperity solution is building algo trading mainly for non-professionals, ordinary individuals. So I have a first question. When the retail traders or individual traders are talking about algorithmic trading, what do they usually mean by that? What is the algo trading in their mind? How does it look like?
Yeah, great question. So at least like we're in more of the CFD space. So I'd say that when people think algo trading, they historically would think MQL5 marketplace. So as you know, like most CFD brokers use the white label platform MetaTrader, put up by MetaQuotes to trade forex, CFDs, and MetaQuotes historically and still to date puts a big emphasis on bots. They make money when people download bots off their marketplace, so they push them pretty hard. And naturally speaking, there is a lot of appeal to bots because people think that, oh, I don't have to do anything. I can simply throw these software on my terminal and it'll make money when I sleep. And I'd say that's where a lot of people get their first introduction. There's also some pretty heavy marketing. Increasingly, like with the AI boom, there's been a lot of marketing about AI trading. So a lot of folks are first introduced to it through that. And so I think when retail thinks algo trading, that's probably where their mind first goes. Bots or especially MetaTrader-based bots to manage their accounts.
What are the assets that are traded mainly? So are they interested more in crypto or, I don't know, commodities, or what are the most popular assets that are traded?
Yeah, I'd say like amongst people that we work with, it's mostly forex, because CFDs have historically been focused mostly on forex. Like, yes, you can trade crypto CFDs, you can also trade index CFDs, which is really our focus, but I think people largely are focused more on currencies, just because that's where a lot of the industry started. Increasingly with many of the crypto exchanges offering bots to their clients, people are familiar with crypto bots. Like BitGet gives them away for free. Oftentimes they're given out by brokers to induce trading. So not necessarily the world's greatest bots because they're meant more to turn accounts and to create revenue for said brokers. But I would definitely say that the most common types of bots are usually mean reversion grid systems, which focus on currencies.
Yeah, and this is the next question. You already answered it. So, I mean, the most popular is grid trading, but what are other styles? I mean, what are the trading styles, trading strategies that are popular? So when the retail trader speaks about the algo trading, I mean, he thinks that this is just the algo trading.
Yeah, like fortunately, part of my content is I review bots. So we make bots, but I've also probably reviewed 200, 300 bots. So I'd say I have a fair amount of knowledge of like what's out there in terms of trading strategies. And most of them, first of all, are pretty terrible. So I think that good starting point, like most of them will just burn accounts or lose money and are done mostly to make a quick $100 by selling a bot. But there are definitely real strategies which retail traders use. And there's a few guys, many of whom I've had the pleasure of meeting, who've been doing this for 20 years with great results for their clients. So it's always kind of interesting to differentiate between like what has actually worked for people and made people money versus what's kind of this almost a way to bring people in with short-term results that ultimately leads to catastrophic blow-up. Like as mentioned, the most common style of strategy are grids, like by far. And as I'm sure your audience knows, grids are usually, your entry is based on a simple mean reversion premise, usually indicator based. So Bollinger Bands or any sort of oscillator would be the most common. And then there's usually some sort of averaging in grid. So Martingale, which as your audience knows, like if you lose, you don't close your losers, you just keep averaging in.
Pushing, yeah.
With increasing lot size, which as we all know is a recipe for eventual blow up. The reason why that's the most common bot is they're easy to sell. Because a very unsophisticated trader or somebody who's, I wouldn't even say is more of an investor, is more of just they're looking to make some money easily, quickly on the internet. They don't want to see losers. And in Martingale, you don't see losers until you see a big loser. And that's why
the last one, exactly.
It's great until it blows up. And that's why it's so popular. And the thing is, though, that style of bot, for the most part, does not appeal to a real investor. So to go to the other styles which have been successful, the number one most successful style that I've seen are breakout systems. The gentleman on the MQ5 marketplace, his name is Wim. He really knows what he's doing. He's been doing this for a long time. Support and resistance breakouts or any sort of breakout trend following is the most common. In terms of mean reversion, there's not many people who successfully do mean reversion systems. They do exist, but because there's way more overfitting risk, generally speaking, it's hard to see robust mean reversion systems because people tend to run way too many permutations, as you know, various indicators, and they look great for a few months, but they usually fall off the category. And then finally, one of my favorite styles, which many of our bots are based on, and we're seeing increasingly more and more in the retail space, are opening range breakouts. And those are, in my opinion, some of the most robust ways to trade for retail traders because it's based on a real premise. You have a market open and you're capitalizing on that volatility. So there's actually a real strategy generally behind it. There's an idea behind it. And at the same time, as you're not trading incredibly frequently, you are far less condition sensitive, slippage sensitive, and you generally can actually have an edge because your trading costs are way lower. Conversely, this style as well generally is not as good for people who are trying to account churn because you won't make as much money on the rebate. So that's why there's almost been this misaligned interest historically, whereas although these styles like opening range breakouts, breakout systems, they work, they generally are less profitable for somebody who's trying to just generate trading volume. So to kind of summarize, like grids, breakouts, opening range breakouts, mean reversion based on indicators, you're probably going to cover 80+% of the market with that.
Yeah. And if I understand correctly, most of the systems are intraday based. Do the retail like to trade for a longer term, like swing trading or, I don't know, momentum trend following for multiple weeks, even months, or all of them are with a very short-term holding period until a few hours or minutes?
In a CFD environment, usually you have very significant overnight holding fees. So although some folks will develop more swing systems, I have found that to pay your overnight swaps are so high that usually it's hard to make an edge around a more of a swing style system.
Yeah. So the swaps are the reason why the retail is trading short-term trading systems, because you do not want to hold the position overnight because otherwise you will pay a lot for it. Yeah, so you can have a lot of the leverage. You can trade the short-term signals, but because of that, and the leverage must be paid somehow, you cannot trade the systems or let's say inefficiencies that are longer or for longer term, weekly or monthly or something like that.
If you're a good developer, that's probably your reasoning. So that's why, for instance, we have some systems which have a weekly signal. So it's based on COT reports, for instance, where we're trying to do trend following for the week because we see an increase in futures positioning amongst certain participants. But there, we're aiming to capture the full week, but we're still going to sell at the close, buy at the open, sell at the close, buy at the open, just to avoid that overnight hold fee. So that would be, if you're a good developer, I hope we're a good developer, but you classify as, if you care about your clients, that's why you're doing that. Most developers would never do a swing system because they want to get their clients excited and they want to generally churn volume. So that's why I'd say the swap, that would be more of a good reason to do it, but it's probably not the main driver. The main driver is people like excited, and also people like to see lots of trades. So a few different reasons.
So it's a casino for a lot of the folks there. And how many strategies, do the retail systematic traders usually run in a portfolio? Do they like just one and they have all of the money in one, or they change the strategies very often? So they stick with the strategy for 2 weeks, then switch the strategy to another one for 2 weeks and then return back, etc., etc. Or they run a portfolio, like real portfolio, 10 strategies, diversified, etc., etc.
People who are successful usually run big portfolios. Like I've seen some very successful retail traders in my journey, and people who do really well, like I think in some ways there's some parallels to institutional traders. You're looking at 10, 20, 30 plus strategies which are well diversified with modest amounts of risk and trying to be as uncorrelated as possible. So that's what successful people do, like almost exclusively. They understand that certain strategies will lose, certain strategies will win. And there is especially a lot of our customers do that because these are very intelligent people and they understand that. The more lower you go in terms of sophistication, the less diversified people will be. So if you have somebody has a $50 account, they're most likely highly leveraged one strategy and they're trying to flip. Whereas we have clients that have large accounts, they're very sophisticated. They're treating it more like how an institutional buyer or institutional trader would.
Yeah, this is exactly the institutional way of thinking. So you are not running one strategy. You have to have the multi-asset, multi-strategy portfolio, and you need to spread the portfolio among the more bets.
Absolutely. Unfortunately, there's no magic box that just always wins, so you have to be diversified.
Yeah, and at the end, the successful retail traders, they tend to overlap in the thinking with the successful professional traders. There is just the difference between how much money everybody of them manage. So that's the difference.
Exactly. We've personally have clients who are professional traders as their main job, and this is their hobby at night. So they work on a desk and they understand, and obviously they check with compliance. Many of these guys do it with prop firms because they're not allowed to trade real capital. And then they'll apply a similar approach with a heavily diversified portfolio in more of a simulated environment. Just because they know how to do this, they might as well make some money out of it, provided obviously they're meeting all the compliance requirements.
Yeah. What are the performance and risk metrics that are expected from the strategy or from the portfolio, the retail level or in this kind of the environment?
People will look at different risk metrics. The one that we like to be the most cognizant of is our drawdowns. You want to rule number one, as we tell our clients, and we've discussed this, don't lose money. So your starting point should always be go for a conservative drawdown. And then at the same time, try and maximize returns and within those parameters. What I have seen with most of our clients and ourselves too, using Monte Carlo tests, being aware of that your worst drawdown is going to be far worse live than it will be in a back test. So you need to be very mindful of that. That's what we see amongst sophisticated retail traders. And then once again, if you kind of go down the spectrum, and I see all kinds of the less sophisticated, they're more return focused. I think a really good dichotomy would be the more sophisticated you are and the more money you have, the more you're focused on risk. Because especially a lot of our clients and a lot of more sophisticated traders, they have money. They don't need money. And that's why it's more about this is a very small percentage of my portfolio, let's say sub 5%, where I'm primarily in real estate, equities, bonds, and I want to have an uncorrelated higher bucket of risk capital. I think bots are cool because maybe I'm a tech guy or I'm a finance guy. I want to play a little bit with this. Let's see if I can do something which is interesting, where I get a higher return, but I'm not going to have an enormous drawdown. That would be probably more the type of client that we usually like to serve.
And how do they define the success? So what is success? I have the great return ratio, or that I made so much money, or I did not breach the drawdown over the next 3 years. What is the success? Because usually in the professional world, the success is defined by Sharpe ratio at the end. What was your Sharpe ratio when you are absolute return fund and when you are relative return fund? So you are trying to beat the S&P 500, whether you beaten S&P 500 and by how much? And what was your tracking error? So how is the success defined by retail algo traders?
It's a great question because in retail, you don't have a benchmark. It's your money. When you go and talk to your investors, you don't need to say, we've outperformed by X. It's you. So as long as you're happy, you're good. So it really will depend on the person. Some folks, maybe if they're learning, they're just trying to not lose money and break even, get a good experience. Whereas some guys are shooting for more aggressive returns. I'd say that people, generally speaking, will look at returns on a monthly basis, partially because when you receive your statements, the broker is sending you generally monthly statements. And a good way to see, people know that on a day or on a week, you're going to have a tremendous amount of variance. But a month It's not the most robust test, but it's a bit more time that you can generally see how your performance is doing. At the same time, people are very drawdown focused, like especially when speaking with higher net worth clients, there is an emphasis on drawdown. So I'd say getting a monthly return which you're satisfied with, it depends on the client. It can be 1%, it can be 5%. And then having a drawdown which is, generally speaking, palatable. And for somebody who's conservative, that might be 5% versus somebody who's a bit more gutsy, that might be 20%. So those would be probably the two kind of pillars which most folks look at. So not so much Sharpe ratio, more so ROMADs or return over max drawdown.
It's like monthly basis, so they are checking on a monthly basis. So it's not the Sharpe ratio or anything like that. That's usually the pros.
No, particularly in certain kinds of algo trading strategies that you see with us, like you would perhaps have a lower Sharpe ratio just because you can make a lot of your returns in shorter periods of times. So that's when like a Sortino might be more effective, for instance, for some of these folks, because there is like, you have these spurts of big wins depending on how they structure it. And sometimes like if they're using a lot of like high risk reward trend following, it might even skew the Sharpe ratios where they look less favorable relative to some of the return metrics. So there's definitely less of a focus there.
And how do they treat the risk? In the retail space, there are a lot of, as you said, about the grid trading, we discussed that. So yeah, grid trading is at the end the martingale strategy. So you can have like nice performance with the small drawdowns and then you have one big drawdown. I believe that as the traders are more sophisticated, they understand that there are hidden risks. The tails can be hard. I mean, how are the retail traders aware of these things? So are they aware of the hidden risks such as tail risk, overfitting, and there can be like regime shifts. So the strategy can work for 1 year and then there can be this change in the regime. How they treat the risk?
I would say absolutely. Like any sophisticated trader, sophisticated retail trader is aware of that. They understand overfitting because especially there's been so many overfit bots sold that many folk were well aware of that risk because they felt the burn personally. At the same time, like many people in retail learn from experience. And I find that if you're trading with somebody else's money, or if you're looking at it from an academic context, it isn't as visceral of a feeling. Whereas I think we all remember the time when you were running 10 bots in one account, where like at the beginning, at least of my journey, where you woke up and you had 50 trades on one day. And it's like, oh no, maybe like if volatility happens, perhaps we should be extremely cognizant of what our VAR is on a given day in case everything fires at the same time. And that's something which is very visceral. I think most retail traders who've been through the journey have experienced enough of that they're aware of many of these different categories of risk. I do think though, because it's experiential though, the one kind of blind spot for many folks would be some of the black swan events. Because yes, they're aware of frequency risk. They're aware of correlations because they've been there during Liberation Day where everything went down simultaneously. And they've understood that you have to look beyond just a basic correlation test between a few different strategies. However, not many people have experienced, we've mentioned the Euro-Swiss franc depegging, or not many folks have experienced that, like, and they've seen that, oh no, I can have these massive schisms. Like I remember working at a fund when I was in bonds, and this was during COVID when oil went negative, and the fund had a ton of oil bonds. So I viscerally remembered when that happened. Granted, I was an intern, I didn't know anything, but it was like, oh my God, like these things can happen. I think because many folks have not experienced that, they haven't exactly felt that pain, and that's probably the biggest blind spot, and why like having conversations with folks like yourself where you understand that is key if you start to actually kind of manage money, because you need to be aware of that.
Basically, they are aware of the things that can happen in the 3 years, and they are happening on a quarterly basis or once in a year or something like that. But there are events that happen once in 20 years. They are not running it on so long history, or they have not experienced them yet. Maybe that is a little blind spot.
Totally.
I understand.
You need to sometimes think like, what's the worst possible thing that could happen? And in funds, there's somebody whose job it is to think what is the worst possible thing that can happen. When if you're just trading your own money, there's so many things you have to do. You're your own risk manager, you're your own compliance department, you're your own accounts receivable. Like there's so many things you have to do. You don't necessarily think like about black swan events. And that's something which I'm always cognizant of, being like, what happens just in case the NASDAQ, I don't know, decides to shoot down 25% in a given day? Like what happens if we don't get filled? What happens if the broker suddenly panics and 10x the spread and we can't get out? And stuff like that can happen. Only the paranoid survive, unfortunately.
Yeah, this is like the disadvantage of retail a little, because in professionals you have the risk manager and portfolio manager, which are two different persons. And at the end, the risk manager has the big red button and he can override the portfolio manager. However, when you are trading by yourself, it's hard because your left side is talking to your right side in your head. You can still say to yourself, yeah, maybe it will not be so bad. So let's take that position. Yeah, let's put the leverage. And as we are discussing the risk, what is the difference between the successful trader, retail algo trader, and that who is unsuccessful? What separates them at the end?
Risk management, like in a nutshell, that is exactly the case. People who focus more on return generally will be less successful than those that focus on the preservation of capital. A great example of this is I recently listened to a podcast with the head of trading at IC Markets, which is one of the largest retail brokers. And there's this one bot called the Waka Waka, which is a really popular retail trading bot. I don't know if you've seen it.
It's a great name. It's a great name.
Oh, it's fantastic.
From the business perspective, it's a great name.
It is hilarious. Frankly, this thing's a grid martingale, and it trades many currencies. And what this gentleman was saying is that people who trade with moderate risk generally have survived the Waka Waka's drawdowns over the years. Whereas many folks will come in because they obviously see the data, they have thousands of clients. Folks who come in and they over leverage, they always blow up. And actually a really interesting thing which I thought was neat is IC Markets can actually use the good traders and the bad traders as counterparties to each other to avoid manipulating the odd cat price, because there's so much volume in this relatively obscure pair. There's always a risk of actually moving the market. And because there's enough people over leveraging, they can almost balance the book internally. And I thought that was absolutely fascinating. And the exact same thing rings true with us. You can see people who just massively over leverage, and you can have an unfair coin, which is right 75% of the time. If you put 100% of your money on it, you're going to lose money. And you see that fairly frequently. And that's really the biggest difference. Whereas people who are conservative, I've seen people get amazing results just by treating it like a business, treating it like an investment, not as a way to generate massive amounts of cash flow. So that's really trading bots in particular. I think you should view it like an ETF. You should view it as you build a portfolio, you have a certain expected return. This is not going to replace your main income. This is just a way to put 5% or 2% of your money in something where you're able to have an uncorrelated, higher risk, higher return investment to other things. And those people do incredibly well.
So at the end, it's about the risk management. Yeah, everybody's talking about it, but people who really pay attention to risk management are the more successful at the end.
Absolutely.
I was a professional trader, but I have a lot of the friends that are, I would say, retail algo traders, and they are successful. And I always take inspiration from them. What are the areas where retail traders can be inspiration for professionals? What can professionals learn from the retails?
I think retail moves fast. Whereas if you're an institutional trader and you have an investment committee, you can't just think of a strategy, implement, and seize it, because you need to get approval, you need to make checks and balances. Exactly. The ability to iterate quickly and have fast feedback loops is really where retail can shine. And in my own journey, when I was developing my first systems, I wanted to just get feedback as quickly as possible, because that enables you to see what works and what doesn't work. So perhaps the one area where institutional could learn is put aside a little bit of money as learning money and just try and iterate fast and just try things and learn through experimentation. I think that's really where retail shines through.
This is very good advice. In professional space, you are right that we tend to spend too much time on research and checking, etc., etc. And the real implementation is always there behind. But if you would do it like you said, so take a small amount of the money and try to iterate on that, we can learn more, because by actually risking the money and seeing how the orders are filled and what is the real spread, we can learn more, and then they can implement that in the backtest than spending a lot of the time on the backtesting and checking and researching. Do you think that there are some edges or alphas that the retail traders see and the big traders overlook them, or there is some structural advantage for the retail traders?
Yes, one that really comes to mind is sometimes in the CFD space, be it prop firms or CFD brokers, the brokers are sometimes able to offer conditions which are different than the market, because their business model, being A book, B book, where they're partially a broker, partially a market maker, is they don't need to make money off of everybody, because there's enough people who lose, which enables them to be profitable regardless. So sometimes I think that, for instance, you can have a 0 pip spread on euro dollar. Like in most areas, in the real market, you're not going to have 0 spread on euro dollar. And that is something which is quite interesting because effectively good traders are being subsidized by the fact that most traders with these brokers lose money, because it's almost like a lost leader, kind of like with Costco gives you your cheap chicken. I don't know, I'm not sure if you guys have Costco, but it's the same idea, right? Like the broker effectively is giving you conditions which are almost sometimes too good, like granted not with the vast majority of assets, but with some which are almost too good because they can make their money off of other people. And the same thing with prop firms, like prop firms are an online casino effectively. And the fact that most people who trade prop firms lose money creates an enormous edge for folks who know what they're doing and treat it like a business, granted provided they get paid out, just because the broker doesn't need to make money off of every trade. Whereas if you're in the futures business where everything is so heavily regulated, the broker is not able to act as a market maker, generally speaking, at the same time, unless there's a payment for order flow, etc. And that's what I found is really interesting.
So because there are more people who do not know what they are doing, it means that when you are skilled retail trader, at the end, it can be easier for you to take advantage of those people that do not know what they are doing. While on the other hand, in the public market, when there are mostly professionals, you are fighting with the professionals, which is significantly harder.
Exactly. Like your counterparty, if you trade with the CFD broker, is most likely a bad trader, because for the most part, they'll warehouse your trades because it's more profitable. So that's why you're able to capitalize on that edge. And I think if you were to get enough, that's why also brokers aren't happy if you try and use arbitrage play or any sort of latency play on their price feeds, because you're gaming the system. But if you find a way to both be compliant, and we have great relationships with brokers, we would never do this to our broker partners, but at the same time, if you find a way to be compliant but benefit from those conditions which are essentially being subsidized by others, you can perhaps create some really interesting strategies. So I think that's somewhere where if you got some really, really smart quants kind of to figure out how do we build an edge around the fact that we can get 0 pip spreads on euro dollar, that could be really interesting.
You can provide the liquidity for a broker when the broker needs it. Basically, because when you find the strategy that's aligned with the broker's need, at the end, you are both doing something that will make sense. So it will make sense for a broker, it will make sense for you, and you will make money. Yeah, at the end, there will be a bunch of the people that will lose the money, but you are providing the service.
Exactly.
To the broker.
You are the liquidity provider as opposed to an intermediary. And it's cheaper for the broker to use you as the liquidity provider than to route your order to Goldman or somebody behind it. Yeah. It's easier because you're interfacing with them. That's fascinating. That's something which we're an introducing broker. We're quite a good sized one too. And I find the kind of how the sausage is made fascinating. How everything works, how the risk management is actually done on the broker side, who they decide to match with who. I only know a tiny portion of it, but it's incredibly interesting. So that's an area where I think you could really get a significant edge.
This is great. Okay, perfect. Thank you very much. I hope that we will have this conversation in the future. For anybody who is interested, that this was Cengiz from ProsperityAlgoSolutions. There will be some info after the video. We also have another video with the Cengiz in which he is asking questions me, so I'm answering the questions. So feel free to visit his channel on YouTube, and you will get the first part of this conversation. And I hope that we will make more videos like that, Cengiz. So thank you very much.
Likewise. Thank you, Rado. It was a great conversation. I'm looking forward to future ones.
Thanks. Thank you.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.